Good morning. You're watching The Market right here on ET Now with me, Aisha Faridi, Avan Dabash, and Anisha Jain as well is going to be joining in shortly on the show. And for the markets, really, the flip-flop continues. Yesterday, we were down about almost 0.5% in trade. A choppy day, but in a narrow band. So a very range session in that sense. Yes, the Adani group of stocks did make a recovery, and they clearly seem to be driving the sentiment home. That aside, you had a whole host of earnings reactions, as would be the case today as well. But let's just map what are the cues that we're picking up this Tuesday morning. And clearly, rising yields have been dragging growth stocks lower when it comes to Wall Street. And the Dow Jones has managed to see a fall for a third consecutive session. Having said that, the US futures are actually inching higher. Remember, the big cue now is going to be the speech coming in from Jerome Powell before the Economic Club of Washington on Tuesday. That's tonight, which clearly remains at the top of investors' mind. Markets did interpret a slew of his disinflation comments as well during the last week's post-meeting press conference as dovish, and stocks did rally for Wall Street. So I think today's commentary is going to be of utmost importance. Don't go by that. What the US futures are doing right now, that is more critical in trade. In fact, let's just map what the US futures are up to, and more importantly, what Asia as well is doing, because right now you're seeing a very tempered move for US futures, but marginally in the green. The Nasdaq futures scaling higher by about almost 0.3%. Asia as well picking up with that same sentiment. Very quiet, but it is a sea of green all across. So Nikkei holding up about 0.2%, Korea is up 0.6%, and Hong Kong is holding up by about almost 1% as we speak right now. So that's pretty much it when it comes to the trading sentiment. But Avan, what about cues from our own markets today?
Well, yesterday's trading session, Aisha, wrapped up with actually a sea of red on the frontliners. The broader markets indeed did manage to outperform. So you did see that gain coming in for the mid and the small cap indices. But across the board, we did witness quite a bit of selling. I say across the board because it was a lot of those high beta pockets that did succumb to selling pressure. Metals being a case in point, energy as well as the IT sector, and then banks as well failed to hold out in yesterday's trading session. So pretty much a negative zone all day that we witnessed for the markets, and IT stocks as well dragged their feet. It was down about 0.6%. The Adani cluster of stocks continue to remain in the limelight, and yes, while you did see select stocks within that basket recover, for instance, Adani Ports was your top gainer on the frontline index, close to 9%. It wasn't that it was across the board. So while there was some amount of recovery in the Adani group of stocks, you didn't see a complete undoing of the kind of damage that we've witnessed over the past many trading days. And yes, indeed, it was the broader markets that took leadership. So you did have the mid and the small cap indices outperforming with quite a bit of conviction at that. And names like for a Vodafone Idea or a PNG Health, Adani Ports, M&M Fin, Metropolis, Varun Beverages, for instance, it was peppered with gains coming in from a lot of those stocks that were all active in yesterday's trading day. But the spotlight as well was on the entire metals basket. Anisha Jain as well joining in. And you had Tata Steel come out with their numbers, Anisha. It was a weak set all in all.
Well, yes, there was a one-off which was impacting the bottom line. But even if you strip that away, there was an inherent weakness which was visible. It was the European business that managed to disappoint yet again. The EBITDA per ton has slipped quite a bit. So that's the worrying point as far as Tata Steel's business is concerned. Of course, the insurance liability had a one-time impact on the profitability, and the deferred tax expense also jumped up to 2,150 crore. And that's the reason there's a big blip on the bottom line. But even if you, talk about the inherent weakness in the other parts, that's something which is a bit worrying. JP Morgan maintains the overweight stance. They have the target at 140 rupees per share. They say that the large PAT loss is driven by inventory NRV hit in Europe, but the key negative was the sharp decline in Europe EBITDA per ton. Though the positive or the silver lining is the fact that there has been an increase in the prices in India, 10% since December itself. So that's positive. And the management commentary also talked about a pickup when it comes to demand in India as well as steel prices, and that's something to watch out for. And even Morgan Stanley, for instance, maintains the target at 110 equal weight, but say that there was the European business that was much weaker than expected and remained a drag, but India business was a bit of a silver lining. But Aisha, not just that, apart from Tata Steel, today you have a whole host of other, stocks which will be reacting. There was this news flow regarding US trying to slap a 200% duty when it comes to the Russian imported aluminium, plus the Novelis data. So a lot of factors to watch out for.
Oh yeah, absolutely. Weak Q3 for Novelis as well. It's not just Tata Steel. Lower aluminum prices, like Anisha was just highlighting, have clearly weighed on the sentiment. And the Q3 shipments as well have seen a decline. In fact, the net sales have decreased about 3% on a year-on-year basis to come in at about $4.25 billion. The adjusted EBITDA as well has seen a drop of about almost 3% coming in. Clearly, high energy costs, inflationary environment have managed to weigh in on Novelis' performance. The net income from continuing operations as well has seen a dip down as opposed to what the market was anticipating at about $96 million. Shipments down 2%, customer reduce inventory, that's been hurting shipments. Auto shipments, however, have seen a rise as supply chain constraints ease as opposed to what we saw in the same quarter previous year. So that's Novelis in trade for you. But a big queue awaits us back home. Of course, there's still a day to go, but you've got the RBI MPC committee as well, wherein the meeting's underway, and we will see the result and the outcome announced tomorrow. Of course, what we're anticipating is a repo rate hike. In fact, almost 100% of the economists and bankers who we polled do anticipate a repo rate hike is definitely in the offing, and a stance change to from the earlier withdrawal of accommodation to now neutral. That is what the street seems to be expecting. Economists, in fact, are seeing a repo rate hike of about 25 basis points, which would take the repo rate to 6.5%. A sustained focus on tracking global central banks to taper the rate hike but defend the rupee. That seems to be top on the RBI's agenda right now. So growth, currency, recession risks, those are going to be the key three watch points when it comes to what the commentary from the central bank is going to be. But I think the big takeaway, Avan, has also been Nikunj's exclusive interview with the finance minister, the first after the budget, and a lot of key takeaways there.
A lot of key takeaways, and I think what the market participants as well would want to closely monitor is the kind of commentary that the finance minister gave when it comes to the capital gains policy, with the finance minister saying that as of now there's been no change in capital gains policy, and to allow for consistency. She also actually acknowledged, saying that the PSBs have realized that as of now they can stand on their own 2 feet, and that going forward there is going to be a lot of focus on the India growth story. She actually said that India is at a stage where the growth momentum needs to be maintained, and they're ensuring that there is policy continuity as well as policy stability. There has never been a doubt, said the finance minister, that the governance and the regulatory framework in the country is lacking, and she also touched upon the currency, saying that she sees the rupee trade gaining a little bit more traction. The budget, the finance minister said to Nikunj, she wants it to be a testament of transparency and accountability, and as well focus and be very realistic when it comes to the tax goals and the tax collection assumptions, saying that going forward as well, they want to be, the focus is to be the right kind of multiplier. Touching upon capex as well, the finance minister did go ahead and say that through capex they are creating demand for core goods, which has generated demand, which has generated employment, and that states as well have shown a good appetite for capex going forward. As I said, when it comes to the PSU banks, she did say that the culture is changing quite significantly, and PSU banks have become a lot more professional. So a lot of tidbits that we got from the finance minister on growth, capex, etc. But also the finance minister said that the government has faith in the Indian regulators, saying they will act when and where necessary, and that she gave comments to reassure Indian investors amid the high volatility in the Adani group shares. She shared her thoughts on the same.
I will not buy for a moment anyone saying Indian governance or their regulatory mechanisms are not good enough. Not at all. In fact, in very many areas, we seem to be leading the way in terms of good governance. I am confident that the Indian regulators are well seized of what they have to do, and they will do the needful where and when necessary. I think the SEBI should be given a time to come up clearly on understanding how this happened, what has actually happened. When I say what has happened, I'm saying it in a lot more deeper sense. I think it's now time for them to get a comprehensive picture, and I'm sure they would do it.
Okay, so those are the key takeaways coming in from the Finance Minister interview, and we'll keep playing the important bites for you all through the day today, and you can catch the interview, of course, on all our social media platforms as well. But Sameer Arora, the founder and fund manager at Helios Capital, is quite bullish on the banking sector as a whole. He's, of course, having a lot more weightage when it comes to the private sector banks versus the PSU banks, and believes that a bank like HDFC will continue to, attract a lot of investors, plus generate a lot of returns. Listen in.
My favorite there is that for 20 odd years, HDFC Bank gave 20, 30, whatever percent returns to the market. And everybody knew 10 years ago also that HDFC Bank is good. And from 2014, it was at foreign ownership limit, which means at that time, everybody knew that it is a favorite stock. And still from 14 to 19, it would have outperformed everything. So just because everybody knows, everybody has it is not enough, except in some situation where suddenly you have big selling or buying of the market, which means more buying of that share which everybody may have. But even we have gone through that phase also now, where the foreigners have sold the financials last year and whatever they've done in the first month of this year. So even better for the banks where there might be lighter ownership of the foreigner, and they are still doing and will continue to do well.
The Indian rupee trade has started with Russia, now it has moved to some African countries, even Southeast Asian countries. Do you see this gaining traction? Because that changes.
Of course, there is a lot of interest. There are, of course, periodically reports in the media saying it's yet to play out and so on, but when you get into nitty-gritties, people do want to convince themselves, but in principle all of them are agreed, and in some it has already taken effect, and some others they're getting into details to work it out. But I think the framework has been well received, and there is a lot of interest for people or countries to get onto that boat.
And we'll get you lots of commentary then from the Finance Minister in that interview with Nikunj. Moving right on then, let's find out the top global commentary from Lawrence Summers to Janet Yellen. What exactly do they have to say regarding the global landscape as well as inflation concerns? Anisha, sum it all up for us.
Oh, well, yes. Let me start with the word coming in from economist Larry Summers. He says that we are not out of the woods yet. Yes, you might have seen that very strong number coming for employment, but that does not mean that inflation or the worst of inflation is behind. In fact, he believes that we had seen a set of inflation indicators during 2022 that were strong, and they have now come back to earth, but still they continue to be quite high, and getting the rest of the way back to the inflation target will still be quite a difficult journey. So let's see when we see the inflation back to that 2% mark. But shifting focus to what the US Treasury Secretary Janet Yellen has to say, she says that you don't have a recession at a time when unemployment is at 53-year low, and the fact that jobs data comes in that strong. So clearly talking about the inherent strong performance and fundamentals of the US economy, and says that the labor market is giving a good sign. The Federal Reserve commentary is expected later today, so we'll watch out for the comments coming in from Fed Chair Jerome Powell. But ahead of that, we got the commentary coming in from the Atlanta Fed President, and he says that the Fed may need to push rates higher. The US Federal Reserve has already, lifted rates higher than expected, but the course is not complete yet, so we might see a bit more upside there. And lastly, wanted to wrap it up with a word coming in from JP Morgan's Kolonovich, wherein he says that the latest stock rally is just a bear market trap. They expect that there is going to be further weakness in the equity markets in the second half of the year, as well as the fact that the disinflationary process, which the Fed Chair talked about last week, is only transient in nature. They expect that there are going to be 2 more Fed hikes in March as well as May before we take a pause. So let's see how that really pans out.
Okay, quite a bit of perspective and food for thought coming in from global market experts. Let's just quickly look at what the SGX Nifty as well is indicating, and 0.5% higher actually. So a significant amount of strength as opposed to what the US futures, or for that matter Asia as well, is indicating this morning. Fingers crossed on that one. Let's only hope we sustain those gains to up until close. I think that's more meaningful. But on that note, let me bring on board Kunal as well as Naresh and find out what they're making of the trade setup this Tuesday morning. Kunal, Naresh, hi, morning. Kunal, let's start off with you. What does it look like? Choppiness is back, although it was a narrower band than what we've seen in the week gone by.
Good morning, Aisha. So yes, it was a narrow band of consolidation for the index. But again, the tone for the market still remains positive till the time we trade above the 17,400 mark. There's nothing major which is happening on the global front as well. US markets have been more or less flat, but when we look at the trajectory for the last couple of weeks, it indicates that the bent and the skew is towards the upside. Now, one of the global charts which have actually given a big breakout is the Dow Jones Transportation, not the Dow Jones Industrials, and that's generally a precursor of a bigger trend which could ensue into the equities as well. So I would believe that possibly we could probably be heading towards an upward move for the US markets, and that should trickle to our markets as well. Net, I think we are trading about the 17,400 mark, so that's an important, strong, medium-term support. And even over the near term, the last couple of days, we've managed to hold on to that 17,700 level. So as an intraday trader, traders could look at holding on to their Nifty longs, even if it's an intraday play. 70,700 could be a stop loss for that.
All right, let's find out Naresh Mirani's strategy this morning. And Naresh, it was the broader markets that really took leadership. The frontliners lagged in yesterday's trading session. The IT index, even banks succumbed to selling pressure. Is that all spelling out a little bit more downside for the markets going into trade this morning?
I would say this is just say a little bit of rejig which keeps on happening. We are still stuck in that range in terms of the momentum yet not shifting. The trend has become positive. We've made a bottom at 17,400. We've bounced back. We've made the same bottoms for the mid cap and the small cap indices. But to get into a momentum move, we need that cross above that 17,970, 18,000 mark, which was hit on the budget day. A similar price point would be needed in other indices as well. And when we look at the Nifty small cap indices or the mid cap indices, they kept on holding on to that September-October lows, which is an equivalent of Nifty 16,800, and have started bouncing. So overall, the view remains positive. It becomes extremely positive once we start crossing 18,000. Till that point of time, it is a stock-specific long, but above 18,000, it becomes something where everything becomes a long.
Okay, so a bit of a positive bias as of now, but 18,000 is that key mark wherein the positions become a lot more confident with respect to the long side. But let's get some money-making ideas from our chartists now. Kunal, what's on your radar?
So again, going with buy calls and focusing more on larger cap names, Bajaj Finance is the stock which I would continue to persist with. I think it's an interesting chart in the making, triple divergence, breakout confirmation. In fact, even yesterday, 2 days back when the stock showed a strong price uptake, post that as well, yesterday we saw the stock seeing a follow through. So that's an indication that this uptrend is here to sustain. 6,250 as a target, stop loss at 5,900. And the second would be a buy on Siemens. This stock is also on the verge of a triangular pattern breakout. This could be a big breakout for Siemens as well, and I would expect the stock to head towards 3160, 3200 over the very near term. Stop loss for this trade is 2015.
Right. Naresh, what stocks have you identified for our viewers?
So first is a buy on LTI Mindtree. The stock has made a bottom and now we are seeing a good reversal out here. Same is the case with a lot of other say small cap IT names. So I would go with Mindtree because that is the one which looks the most promising one right now. And I've seen good momentum yesterday as well. So I would expect it to go towards 5,000. A stop loss to be kept at 4,500. Second is a buy on L&T Finance Holding. Now, what we are seeing is after banking, we are seeing a good trend across the whole financial pack. We saw M&M Finance break out yesterday into a new 52-week high. IDFC break out into a new 52-week high. The next on the radar would be L&T Finance Holding. The stock has made multiple tops around 95 levels over the last 6 to 12 months. On the downside, it has held on to that 84 mark and started reversing yesterday. So a good risk reward trade here with a stop loss at 86 and an initial target price of 100.
All right, there you have it. Those are some top recommendations that are coming in from our chartists flagging off their ideas for trade this morning. Well, let's hear it out then from the Finance Ministry announcing no change in capital gains policy to allow for consistency. That's the word from the Finance Minister Nirmala Sitharaman in an exclusive chat with ET Now. Listen in.
We don't want to keep changing too many things in too few short time. Capital gains tax, the last amendment was probably in 16 or 18?
2018.
18. And subsequent to that, ideally even 3 full years of not even gotten completed. So do you want to change the policy immediately? No, you would want to see how it works out.
Well, at Times Network, we are always looking to create investor awareness and make financial matters simple for our viewers. Keeping up with our values, we present the second season of Nivesh Ke Fund. On this edition, we discuss India's economic growth and how that can benefit you.
Hello and welcome to yet another edition of Nivesh Ke Fund. I am Ajay Sharma. Now it's a well-known fact that India's economy is on a very strong growth trajectory.
Yes, Ajaya. In fact, India is considered the fastest growing emerging economy across the world.
But Kavita, how can the everyday Indian be a part of this growth story? And what are some of the avenues that they can explore?
Now, one of the relatively easier and simpler ways to do this is to invest through mutual funds.
Absolutely, mutual funds provide the investor an avenue to invest in multiple asset classes.
Yes, Ajaya. Through mutual funds, an investor can get access to equity of shares of the Indian stock market as well as global stock market.
Not just equity, they can invest in bonds and debt market and even invest in gold and silver through the mutual fund route.
Right. One more thing, Ajaya. By investing through mutual funds, a person can invest in small denomination and does not have to make large investments at one go.
Yes, this helps the investor continue their investment at regular intervals for a long duration of time. Additionally, when a person needs money, they can redeem the mutual funds unit worth the amount they require easily.
Absolutely. One does not have to sell the entire investment. Thus, one gets the benefits of liquidity and flexibility also.
So if you believe in India's growth story, make sure you're a part of it. And an easy way to do that is by investing in mutual funds.
And with that, that's all on this edition of Nivesh Ke Fund. Thank you for watching.
Welcome back to the market. Lots of stocks that are making the news. Let's begin then with the latest note Morgan Stanley has come out with on LIC Housing Finance. Now, the brokerage has maintained a bearish stance on the stock. They've got an underweight rating with a target price of 320 rupees. Let's find out why. Vamakshi joins in with those details. Vamakshi?
Well, absolutely. When we look at the numbers that the company reported, NII saw an uptick of nearly 11% on a year-on-year basis. Revenue saw an uptick of nearly 16%, but it is the net profit that actually saw a dip of nearly 40%. It has declined from 771 crores to 462 crores. Impairment on a sequential basis were also nearly 104% higher. They've gone up from 374 crores to 763 crores. So on the back of that, we actually have a note coming in from Morgan Stanley. Now, what they're saying is that slower improvement in loan spreads actually caused the 12% NII miss. While reported NIM was flat on a year-on-year basis, it was up nearly 60 basis points sequentially to 2.42%. Incremental borrowing costs were also higher by nearly 72 basis points to 7.3%. 0.61%. Now it appears that there has been a significant sacrifice in interest income by way of repricing terms that are actually favorable to customers, and that could be on the back of the company's intention to retain customers. Operating costs, in fact, when we look at them, were nearly 13% above their forecast, which actually caused the PPOP to miss estimates by nearly 17%. Now, given all these factors, profitability actually took a hit, and in fact, it came in nearly 55% below Morgan Stanley's estimates. On the other hand, home loan disbursements also fell by nearly 5% sequentially, but we're seeing that there has been a slight improvement in the asset quality, but the provision cover was also quite higher, which is a positive coming in for LIC. But despite this overall mixed set of numbers for LIC, PAT has missed estimates by nearly 55%, and on the back of that, Morgan Stanley has maintained an overweight rating on LIC, given a target price of 320 per share, and from the current market price, they're actually expecting to see a dip of nearly 18%.
That's quite a substantial miss coming in from LIC Housing this time around, and the stock will definitely be in focus on the downside today. But the other stock that could be in focus on the downside is Hindalco. Its wholly owned subsidiary Novelis came out with the Q3 earnings, and the net sales have decreased by 3% on a year-on-year basis. There has been a decline when it comes to shipments as well as the challenging cost environment is something that continues to impact the EBITDA of the company. Asesha is now joining us with the fine print of the earnings.
Absolutely. Challenging macroeconomic environment and high energy cost impacted Novelis' numbers this time around. Novelis, which is Hindalco's wholly owned subsidiary, reported a decline of 3% on the top line, and that is because of lower aluminium prices that prevailed during the quarter. As far as adjusted EBITDA is concerned, that also declined by about 33% on a year-on-year basis because of high energy cost and high inflationary environment in developed economies. As far as shipments are concerned, they declined marginally by about 3% on a year-on-year basis, and that is because customers reduced their inventory position in the quarter gone by. We have a couple of brokerage notes that have come in on Novelis. Macquarie has maintained an outperform rating on Hindalco with a target price of 517 rupees per share. They say Novelis reported a weak quarter this time around. Recovery outlook because of the weakness that we saw in the quarter gone by has now been pushed further. For a quarter, EBITDA was impacted by about 8% on a quarter-on-quarter basis, and that was because of decline in volumes that we saw in the quarter gone by. All in all, weak set of numbers have been reported by Novelis, which is Hindalco's wholly owned subsidiary, and that is mainly because of high energy costs and inflationary environment that was prevalent in developed economies.
That's the latest note coming in on Hindalco, but let's focus in on Tata Steel as well, Ashesha, as the company post-market hours yesterday reported a loss of 2,500 odd crores in Q3. EBITDA as well is lower by 33%. Walk us through some of the key highlights and what has led to this performance as well as that additional tax expense that weighed on the profit.
Absolutely. We were expecting weak set of numbers from Tata Steel this time around, but the numbers have been much weaker than what the street was working with. Profitability this time around has been impacted by sharp drop in realizations and decline in spreads in Europe. As far as the bottom line is concerned, remember the company has reported a huge loss of about 2,500 crores, but that is because of deferred tax expenses that the company has booked in this quarter. As far as standalone adjusted EBITDA per ton is concerned, it has increased by about 16% on a quarter-on-quarter basis, and that is because the company enjoyed low coking coal prices during the quarter. Debt position largely has remained stable on a quarter-on-quarter basis for Tata Steel. We have a couple of brokerage notes that have come in. First up, we have JP Morgan, which has maintained its overweight rating on Tata Steel, and they've given a target price of 140 rupees per share. They say large loss this time around was driven by inventory NRV that was hit in Europe, and the key negative was the sharp decline in Europe EBITDA per ton that we saw in the quarter gone by. Meanwhile, Morgan Stanley has maintained equal weight rating on the stock with a target price of 110 rupees per share. They say European business was a big drag this time around. European business has reported numbers much weaker than what they were working with, and large deferred tax expenses towards pension scheme has impacted the bottom line. All in all, Tata Steel has reported weak set of numbers much weaker than what the street was working with, and that is mainly because of the weakness that we saw in European operations.
Okay, Ashesha, we leave it at that. Tata Steel clearly is going to be one stock to look out for today. By the way, Paytm also reported its numbers and a very healthy Q3 earnings is what they've posted with a 42% increase in the revenue, and the loss is clearly narrowing to 392 crores. Let's hear out what the management had to say in their conference call last evening.
EBITDA profitability that we have done operatingly, we will continue to increase the EBITDA profitability. Could it go 2-digit? In what timeline, I don't know, but yes, it could go 2-digit for sure. And like I said, this is a sustained EBITDA growth that we are seeking from here on. We are definitely making sure that we have sustained and growing profitability. I also want to remind you that we would have lots of investments coming up and in growth and market opportunity. You've seen it that we've never ever compromised. Important thing is disciplined growth in profitability, disciplined contribution in growth and marketing. These MTU additions, as you very well have seen, are not driven by cashback. Instead, they are driven by good marketing that is led by referral marketing and great product initiatives.
We have not slashed cashback or anything of that sort. Our contribution margin continues to improve. So we do have room if we wanted to increase cashback, but there just hasn't been a need.
Okay, let's get a view from Deven Choksi as well. He joins us on the show. Deven, let's start by talking about Paytm itself. It does look like the management is becoming a lot more confident, and so are the brokerages now.
Yep. Good morning, Anish. Well, I think definitely for the first time we are seeing the reduction in the loss on the quarterly basis, and that probably I think raises now the expectation that in given or coming quarters, I think you would probably start seeing the company breaking even and maybe I think getting into the profits. What it would mean for the company, I'm not completely sure at this point of time, because one would like to see how this particular business model will sustain going forward. They are making their best efforts in different verticals in form of bringing down the cost and I think trying to generate higher amount of EBITDA. But whether I think this would sustain, I think that will be the time-tested requirement I think that one would like to look at. But as of now, worst seems to be getting over for this company, and that's a good news.
There's lots more to talk about, but meantime, let's also focus in on some other newsmakers. The government has raised objections to Vedanta's proposal to sell its international zinc assets to its subsidiary Hindustan Zinc for nearly $3 billion. Let's take it across to my colleague Anuradha Shukla from the Economic Times, who joins in with the latest. Anuradha, what exactly does the ET report state?
The government has raised objection on this Vedanta Resources proposal to sell its international zinc assets, which is valued for nearly $3 billion. Now, the center's objection is that this valuation is slightly on the higher side, and it will have an impact on the share prices of Hindustan Zinc Limited. The problem of center is that it is banking on the stake sale in Hindustan Zinc Limited, and to meet its divestment target for this fiscal year. So, if the valuation stays on this higher side, so then it will erode the share prices, and it will become very difficult for the center to raise their divestment, to meet their divestment target. Another objection is that the center is saying that it is the way Vedanta Resources have cleared the sale of its international zinc asset. It was done by ignoring the rights of minority stakeholder. So that is another problem. The sources have told ET that objections were already raised in the board meeting, and going forward, center may initiate some action.
All right. Thanks very much, Anuradha, for filling us in with all those details. Meantime, let's get in a view then, Deven, from you. Wanted to just get in your thoughts on the entire metal space as a whole. For instance, what your view is on, this opposition of the asset sale proposal from Vedanta, the kind of earnings that we saw from Tata Steel as well coming in, some of Novelis's highlights given the fact that we did see aluminium prices weighing on their sales numbers.
Seven, well, obviously, this kind of environment in which on one side you have a sharp fall in the commodity prices in a given quarter, there is going to be a situation where the mark to market on the inventory will have to be provided, and that's what has happened in the last quarter. In my viewpoint, I think this seems to be over because the crude oil prices have stabilized at a lower level. So are the commodity prices, and I think the downside in the commodity prices is arrested from what it was, I think, to the sharp fall of around 20% plus in most of the global commodities. I think that fall is arrested. In my viewpoint, I think given the nature of the commodities and given the kind of a steady improvement that we are expecting, maybe in subsequent quarters from now, we should be seeing at least improvement in this particular area. And the losses that they had to provide on the mark-to-market basis for this inventory that they are carrying will not be coming in the fourth quarter and so on. Given that situation, I think the metal commodity companies, including Tata Steel, should be registering better performance in the fourth quarter. Very difficult to predict numbers in commodity cycle because I think the kind of provision that the companies make in their books is not something which is easily available to analysts to understand. So, but I think the directional call, yes, I think the things are likely to remain relatively more stable going forward. There should be a buy opportunity at corrected levels.
Right. And Kunal, in the 1 month, we've also seen how pressured some of the metal stocks have been, and in particular Tata Steel. But do you believe that the stock may be close to a buy now?
Well, I would say that it's a very average kind of a buy for Tata Steel. It's not something which has been rip-roaring for the stock or chart, a trend changing for Tata Steel, because the stock has grossly underperformed in various time scales. Whether you look at 1 month, 3 month, 1 year, 2 year kind of a time scale and compare this with the likes of JSW Steel, Hindalco, Vedanta, etc., the stock has underperformed. It's just that off late the stock has shifted its base. Earlier the stock used to spend a lot of time consolidating at the 108, 100 to 108 mark for many months at a time, but the base has been up and now we're seeing 118 to 120 as more of a strong base for the stock, and it's trading about those levels. So I would believe that it's just the comfort of the base being shifted up higher, which has happened for Tata Steel, but nothing major in terms of the chart patterns which has changed. The stock is still trading just slightly above its 200 moving average, and when you try and compare this with the larger cap names, JSW Steel, mid cap stocks, Jindal Steel, these stocks have comfortably above their long term averages, even in fact with a margin of more than 10 to 15%. So that's the benefit with having longs on likes of JSW Steel or Jindal Steel, and Tata Steel is underperformed in that accounts.
Devent, we can't not talk about the Adani group of stocks, right? But the question is, do you think going forward the incremental volatility in the Adani stocks will be a lot more tempered? Do you think the worst is behind, and maybe somebody with a big risk appetite can probably look at buying some of the names?
So I think at the risk of proving wrong, I think I may want to say that the elephant is out, but I think the tail is still in. What I mean to say here is that I think majority of the fall probably is already factored into the market today, and maybe I think that some part of the fall could be cannot be ruled out largely because of the MSCI related adjustment issues. Should that forces people to sell their holding because of the weightage reduction, etc., at least for those funds who have not yet sold it out, I think there could be, I think, a challenge on that front. And this is more technical than anything to do with fundamental. In my viewpoint, I think the fundamentals and the business of the company's assets, I think group's assets, they remain absolutely, I think, convincing and clear. The kind of cash generation on these infrastructure assets that the company is reporting, my reading says that I think this is going to only grow from here because infrastructure assets generally have the tendency to keep producing at a higher level, I think, once the volume increases on the assets that they have created. So I would remain relatively more optimistic as far as the fundamental prospects are concerned. Technically, I think the situation can prove me wrong at some point of time, so I'm not too sure on technical aspects.
We will get a check definitely on the technical aspects as well of the Adani Group names. But we are in a very different era of recapitalization of banks. That's the word coming in from the Finance Minister, Nirmala Sitharaman. She believes that PSU banks can stand on their own feet now with healthier balance sheets than before. Here's her exclusive chat with Nikunj just last evening.
There's now not just one call anywhere, not even one word anyway saying, are you planning to recapitalize? No, banks have realized that they can stand on their feet. They can raise market monies from the market, and they realize it actually gives them a better spine with which they can stand up and speak.
Right, that's the finance minister giving her take there. Moving right on then, we will get you that interview at 9:45 a.m. But in the meantime, Naresh, I wanted to get in your thoughts. Apollo Tyres hitting a fresh record high this month. Are the technicals suggesting that that traction is going to continue? And what's the view on JK paper on the charts, given the kind of healthy quarterly numbers that the company reported?
So Apollo Tyres has been on a strong trend for the last almost 6 months, ever since it started breaking out about 220. But the problem is every time it makes a breakout move into a new 52-week high, the stock makes a slow and very steady move. So the last time it broke out about 305, 310 levels, it made a slow and steady move to 340 levels. And now we are again seeing a pause after that 340 and now starting to make a move above 340 levels. Could go slowly towards 380, 390 in the shorter term. So would be a buy on dips with the stop loss at 320.25. So looks interesting, but I would expect it to be a slow and steady move. JK paper, on the other hand, is something which has been sideways. It has tried to make that breakout move multiple times around that 430 to 450 mark. So I would expect a dash towards 430, 450 today. But only if it can sustain 450 would we call it a breakout of the last 4 months. So for now, would wait and watch for price action today post the numbers.
Okay, those are some of, some trading strategies or some stock calls really coming in there. Also, Devin, wanted to understand how is it that you're now approaching Idea and with all the news flow around the bailout from the government?
So Aisha, I think I am struggling to find, what kind of business model Idea is going to continue now and later. I think I am not having clarity at all on this subject. On one side, the industry is rolling out 5G and 5G related infrastructure. And I think they are basically creating the larger amount of pool for the attracting larger amount of data traffic onto their network. I think Idea is not getting into that at all. Idea is not getting into that at all because of the constraint of resources. On the other side, I think they are losing their customers every 6 months, and basically as a result of which, probably I think they are now going to left with revenue book which is going to be too small because the larger customers will certainly shift to the better network which is offering them services. Given that kind of a situation, government is trying to take the equity stake, converting the debt into equity. Again, I'm not too sure, how they are going to achieve the purpose. They haven't been able to achieve their purpose in MTNL, BSNL for last so many years. And now they're adding one more portfolio into their investment, which according to me, not making much sense. Unless they found out some genuine buyer who wants to take away the stake of the government, I don't see any reason for any investors to, get convinced about this particular subject. So let's wait and see for more clarity to emerge. But certainly no, we have never been invested into this particular company and would not like to invest till the time this clarity emerges.
Devin, what about ITC? That stock, of course, is sitting at record high level, but now there are reports doing around that this attractive price level is something that might interest the government to offload some stake. Do you think that can bring in the supply pressure and cap the upside on this one now?
So I think my understanding on ITC is that each of the business verticals have probably started maturing, and many of these verticals are ready for a standalone journey as far as their business operations are concerned. That means that those verticals could possibly separately come into the market for listing. Consider agri vertical, consider FMCG vertical, consider hospitality vertical, and IT vertical. Each of these verticals have their own inherent strengths. And if they come separately for the listing, in my viewpoint, the valuation unlocking could possibly result into a better prospects for investors as a whole. Currently, this realization is possibly driving the stock prices into the forward direction, which is fundamentally okay according to me. The business remains absolutely convincing. So from that perspective too, I feel that ITC probably remains as a stable investment going forward in the portfolio.
Okay, let's just get back to the Adani group of names. And we chatted with Mark Mobius just yesterday from Mobius Capital Partners, and he decoded the Adani saga. Of course, caveating that he's not invested in any of the Adani names, but here's what he had to say.
What happens is that the major investors, the multi-billion-dollar investors, what they end up doing is buying the index. Or even if they're trying to be active investors, they're so big, they're forced into companies like Adani. So in our case, we don't have to worry about that. We're not $1 billion funds. We're millions, hundreds of millions of dollars in our funds. And we can concentrate on companies that have very little debt. And the thing that scared us about the Adani companies, of course, is the debt. So at the end of the day, those foreign investors who were sort of forced to go into these big market cap stocks got burned, and of course they got scared. But at the end of the day, the outlook for India still looks excellent.
Deven, your view on ITC, the stock hitting a 52-week high yesterday, and reports indicating now that the centre has revived its plan to sell part of its indirectly held stake in the company, and that transaction could be completed within the current financial year. What would this mean for ITC?
As when I explained, I think the business outlook for ITC's different vertical remains absolutely promising. And I believe that I think these verticals have inherent strengths to, I think, get separately listed eventually. In times to come, I guess I think the agri vertical, the IT vertical, the FMCG vertical and hospitality vertical, each of these verticals could possibly unlock higher amount of values for investors and could possibly sustain their growth in going forward period. So I would remain, I think, relatively more optimistic whether this transaction or otherwise. I would think that I think this particular company remains relatively more promising than ever before, given the kind of strength that they have created in each of their verticals in the business. Separate listing would mean good amount of value unlocking for the investors.
Right. Deven reiterating his views on ITC there, but Kunal can't help but focus on the big breakouts from yesterday, both Indus Towers and Idea. Let's just reiterate for the benefit of our viewers who are just tuning in.
Well, nothing major, I would say, for Idea, Vodafone Idea. I think the stock is still languishing at the 7.5 to 8.5 levels. When you try and compare this with the bigger highs for Vodafone Idea, this is just maybe a very short-term kind of a rally for the stock. I would not be too much enthused into buying this name because of the fact that it's extremely volatile as such. Even for Indus Star now, the only reason which I would probably attribute for a bigger rally and possibly an upward trend would be a major mean reversion towards the 200-day moving average. So just about almost a week back when the stock was 135, 38 levels, the 200 DMA was almost 200, which means there was a divergence of almost 65 to 70 rupees for the stock from its 200-day moving average. That's almost 35%. For the stock price, and such kind of strong divergences from the longer term averages, they don't sustain for a longer period of time. And when the mean reversion happens, the stock eventually and gradually moves towards closer to the 200-day moving average. Yesterday the stock closed at 160 plus levels, which means there could be a possibility of another 20 rupees, 25 rupees on the upside over the near term. So if I have to bet on either of the two, I would go for Indus Star because of the fact that the stock would go into a mean reversion and possibly a targets of 180, 185.
Okay, meantime, let's also get in a view then, Naresh. What is the charts indicating when it comes to an ABB as well as a Dr. Lal Path?
So ABB has gone through a sideways or a downward drift after a huge rally from 2000 to almost 3400. And now after consolidating for the last 2 months in a range of 2700 to 3000, the stock is setting up for a breakout above the 3000 mark. If that happens, we go back towards 3300, 3400. Yesterday was a good price action, so out here looks interesting for the near term. Would actually preempt a buy here with a stop loss at 2850 and keep a target of 3300 here. So positive on the stock. Dr. Lal Path Labs is something I would be very cautious on. The stock has corrected from 4000 plus all the way down to 1800 to 2000 rupees. Now this is a very important support zone for the stock, 1800 levels. That was the bottom made in May. As well as pre-COVID, the stock used to trade around 1800. So the whole outperformance of COVID has been taken out. And what we've seen is in a metropolis, when it broke below those pre-COVID levels, it went another 20% lower or much more than that. So out there, 1800 remains that pivot point, but technically the downtrend is still pretty strong. So if it breaks below 1800, that is where it could get much more worse for the stock. So would not be looking at bottom fishing here.
Okay, a lot of other stocks which are going to be in focus. Hindalco, given how Novelis' performance has been and the sales have contracted about 3%, the total shipments as well have seen a dip of about almost 2% coming in. Tata Steel as well, the numbers have fallen short of what the analysts were expecting. Even if you adjust for that one-time adjustment, even then the numbers are not at par with what the street was anticipating. So the Q3 is below. The adjusted EBITDA has come in at about 10,379, which is starkly lower than 11,000 plus that the street was actually penciling in. LIC Housing Finance as well, and the numbers are sub what the street was expecting. The dispersals have seen a downtick of nearly about 9.5%. And then, of course, there are a whole host of other earnings as well. There's, of course, Adani Transmission, there is JK Paper, there's Hitachi Energy as well. The numbers have been quite good. ACE, that's Action Construction, those as well are numbers that the street is going to be looking out for today in terms of a reaction. But they even wanted to understand whether in the last month of volatility and weakness that's played out in the market, and more so for the mid and small caps, if you've added any positions within mid and small caps in your portfolio or advised clients?
We have been liking some of the auto ancillary companies largely because of the fact that the auto OEMs are now going to report steady numbers going forward, particularly commercial vehicles and passenger vehicles. Of late, I think the last month data also suggests that two-wheelers have started showing reasonably better performance. So the conviction remains higher with some of the auto ancillary companies which are there in the mid-cap baskets into the market. And they could possibly once again start performing better going forward in the current year, because behind them is the surge in the metal commodity prices, which affected their margin for a while in the last year as well, and continuing in this current year also. And at the same time, I think the demand scenario remaining absolutely convincing. I would think that the auto ancillary companies which we have started picking up in our portfolio remains, I think, relatively a stronger proposition. Similar is a situation with, I think, the 5G rollout and the companies covering the 5G related rollout space. A couple of them in the market listed place, which we like. I think they have started presenting themselves, I think, good opportunity. In the defense space, I think some of the mid-segment companies are looking promising, and maybe they recently listed. So maybe I think one will have to wait and see how exactly they sustain their quarterly performance to get the full judgment on the full year performance hereafter. So yes, I think we like, I think, some of the ideas into different places, including auto, defense, and into the 5G ecosystem space where the companies are operating.
And talking about the entire defense sector, yesterday, of course, you had Prime Minister Modi inaugurating one of the helicopter facilities at Hindustan Aeronautics, and we'll try and get you that footage as well. That's one interesting theme that has been playing out. Naresh, in the meantime, is there any defense name that looks attractive on the charts, given the fact that they have all run up considerably?
So I would go with something like a Bharat Electronics, which has gone pretty sideways, has been relatively an underperformer in the whole defense rally in the last 6 to 12 months. The stock has gone through a consolidation, was at 115 in the peak of September, October, corrected and retested the last breakout point of 85.90, and is now slowly making a comeback. So this is a good entry point for a medium to longer term view in the defense space. One of the best performing defense stocks in previous cycles also. So this is a stock which did really well in 2000 to 2007, as well as in 2014 to 17, and as well as from 2020 when the whole rally started. So the stock used to be 40 rupees pre-COVID and is still at 100 rupees, 90 to 100 rupees. So Bharat Electronics is one, and second would be Bharat Dynamics, purely for the reason that it has gone sideways for the last almost 4 or 5 months. It gave a big move in March to September, but post that it has been sideways, but it has not corrected sharply. So it continues to trade around 900 to 950 for almost the last 4 months. So this is something which has gone through a good sideways consolidation and the next leg could be up towards 1200, 1400. So in defense, I would go with Bharat Electronics and Bharat Dynamics.
Interesting there, but the problem with Bharat Electronics has been that for the last 2-3 quarters they have disappointed with respect to the order inflow, though the management is still quite confident that they will be able to at least meet the target that they had set for themselves at the start of the year. But IT, Devian, how should one approach IT now? Because names like Persistent Systems, etc. have already gone up 25% this year. Would you rather bet on the niche plays, the likes of Tata Elxsi, KPIT Tech, etc., or going with the large caps?
So I think the large caps definitely shows the visibility of revenue for next 5 to 7 years because of the contracts that they've been winning in this many in last few many quarters. I think that we have seen both TCS and Infosys remain absolutely strong proposition on that front as they keep on adding the billion-dollar customers on every single quarter, which gives them the visibility for 5 to 7 years of revenue. They remain convincing. And at the same time, I think the need for the IT services, I think, is always been there and is likely to grow even further from what it used to be. In fact, I am getting a similar kind of understanding that what it used to be in 1990s, the need for IT and services, I think in these particular times, when you are having a situation of most of the companies reaching out to the customer directly, adapting to SaaS platform, going into cloud computing, and entering into AR, VR kind of a platform. So in my viewpoint, I think the business condition remains absolutely conducive for them, even except I think in some pockets of the world, there might be some amount of slowdown, I think, in releasing the orders. Indian space, I think some of the mid-tier IT companies looks really interesting. They have reasonably good amount of niche and the model to follow. And at the same time, the growth rate would be higher compared to the frontline IT companies. And I'm talking about the likes of LTTS or LTI Mindshare, or for that matter, even Sand Technology, Tata Elxsi kind of companies. They remain reasonably, I think, strong proposition from the point of view of growing, I think, at 25% and above, at least in the foreseeable, visible few quarters, I think, from here onwards.
All right.